Welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Lori Greymont, and she's with Summit Solutions Team Corp. She's the Vice President and Chief Operating Officer for that company, and she's been working in real estate for 20 years. Lori started out helping her mom and dad rehabilitating properties, and so she's really good with a drill and a hammer. Lori says that her husband married her because she had better power tools than he does. Summit Solutions helps connect investors with opportunities with bulk bank foreclosed properties, which these days are also known as REOs. So when you hear that buzzword, that's what people are talking about. But today, Lori and I are going to be talking about real estate investment alternatives. So, Lori, welcome. Thanks for joining me today here.
Thank you. Thank you for having me.
Oh, it's a pleasure. Now, folks, before we get started, I'm going to warn you, we're just going to be giving you an introduction to some different ideas. Real estate investing is a complex area that requires a lot of study and due diligence. And so be careful out there. We're just sort of introducing you to some ideas that you may want to investigate further. Okay, Lori, let's get started. So why should people be thinking about real estate investment alternatives now?
Well, as we all know, the stock market hasn't necessarily performed nicely. You know, people have lost major portions of their retirement, and they're looking at how are they ever going to recover it. And so real estate has also gone down, and so what a perfect time to buy than right now. And so moving some of their stocks and investments into real estate is a good way to diversify.
Mm-hmm. Okay. So what we're going to do is we're going to talk about a number of little areas of real estate and what are some of the advantages and what are some of the disadvantages. And so because many people are going to be looking for replacement of passive investment income, savings accounts or bonds or stocks, we're going to start by talking about alternatives that don't require a lot of attention, that are more passive. So let's first talk about, and maybe in a sense this will be the most active of the bunch, but we'll talk about rental properties. So Lori, well, let's start with residential rentals. And what are some advantages and disadvantages of getting involved in this area?
Sure. So when you buy a property and you rent it out, what you're looking for is cash flow and appreciation. So right now, we don't know when the market will start appreciating, but we know we're pretty close to the bottom, so it's a good time to buy for that appreciation. Mm-hmm. So then you're going to get the cash flow, but the cash flow does not come without headaches. Many people are used to managing a 401k, which is the paper comes in and it goes into the filing cabinet, and that's what we do to manage. When you have passive income coming from real estate, no matter which area it is, it takes a little more management than moving the piece of paper. You are going to have to manage your managers. Property managers will either make you profitable or not profitable. And a lot of people end up managing their own properties because it's easier to manage the tenants than it is to manage the property managers. So it's one of those areas where you have to be good working with people, and if you are, you will be successful. Now the other side of residential is commercial. And commercial has different headaches. It's dealing with the vacancies that you have. And right now we're seeing a lot of vacancies in the commercial market because businesses are failing. Mm-hmm. So I would say if you're going in for the first time, start with residential and wait a few years before you move into commercial.
Okay. Now there is, I guess, a point to bring up, and that is in California for a long time it seemed like positive cash flow couldn't happen with the real estate. I mean, it was inconceivable almost, and we're in California, of course, in San Jose. But I've been hearing rumors that actually you can get positive cash flow in some places in California now.
in many places in California, you can find positive cash flow. It's amazing that we're finding homes that will cash flow $1,200 a month, and you're paying less than $90,000 for that house.
$90,000?
It's amazing what the cash flows can be, but you have to watch where you're going because where you go into the lower end neighborhoods, you're not going to see the appreciation. So you want to find a balance of controlling an asset that will appreciate and getting the cash flow.
Okay. All right, well, the next area that I'd like to talk about in this passive area is real estate partnerships. So there's actually entities, in the sense that we've got a group here. It can be a limited partnership. Another area is limited liability companies, and then actually an alternative, tenants in common, or TICs some people call them. Right. So let's talk a little bit about this area and the alternatives and advantages and disadvantages.
Okay, so let's start with TICs. TICs are tenants in common, and typically what it is it's a bunch of people pooling their money together to buy a large commercial piece of property. Maybe it's a building that has doctor's offices in it, and there'll be a management company that will manage it, take a fee for managing it, and then give you some cash flow every month. The advantage of a TIC is that it's usually a more stable, slower growing, lower risk investment. The disadvantage is that the management team is pulling a lot of your profit out because they're getting paid. But you can actually do 1031s with TICs. You can 1031 into other investments, which is another tax advantage to going into something like that.
So a 1031 is a tax-deferred exchange, and because you own your own piece of this investment, if you, for example, have a rental house over here and you're tired of the management headaches of that, and maybe you're getting more into the retirement mode, you can exchange out of that property into a tenant in common ownership format, and then have the management company take care of the actual problems of the property, most of them.
Yes, yeah, and you always have to manage your managers, but it is a good alternative when you're moving into a retirement phase where you want to preserve your principal and have income coming in. So that's one way. Other type of partnerships are to find entrepreneurs who are going to put in the sweat equity, they're going to fix up properties, they're going to do something like buy REOs and resell them, where you form a partnership. You bring the money in, they're going to do the daily activity, and you either get a piece of the action at the end, or you can participate with maybe monthly payments on your money. Now, these are typically a little riskier because you're working with people who aren't bringing their own money to the table, but they usually provide higher return for the risk. There's not a 1031 exchange option in this because you don't have your own piece of the pie that you can transfer in or transfer out. So this would be a good thing to use your IRA money for, because you can take your IRA money and put it into a self-directed IRA and then invest it into a company or partnership this way.
Right. Now, if they have debt that's involved, people need to know that there may be some unrelated business income. Means that there has to be actually an income tax return filed for the IRA or Roth, but still, it may be a better alternative than the other things that you can do with the money after tax and so on.
And the key is there's income. I mean, if there's income, you know, I always like to say, if there's income, that means I'll pay taxes, but if I'm paying taxes, it's because there was income, which is a good thing.
Yeah.